Hello, and welcome to eOptions webinar, and we're excited to have you here. Thank you for taking the time out of your day to join us. We partnered with the Options Industry Council, or OIC, today to bring you this webinar on hedging using options. My name is Gina Bocayas, and I'm with eOption. Just to give you some details on the webinar today, the session will last approximately 1 hour. If you have any questions during the webinar presentation, please feel free to type them into the Q&A box on the bottom of your screen, and our speaker will be happy to answer those at the end of his presentation. Also, you can reach out to eOptions Trade Desk or our Customer Service Department at any time if you have any additional questions after the webinar about options trading or option strategies. And for those of you just joining, we'd like to welcome you to our webinar today on hedging using options. I'd like to turn our attention now to our speaker, Ed Modla. Ed has over 20 years of experience in the financial industry. And to tell you a little bit about him, he started out his career with Hull Trading Company, where he was an options market maker on the Chicago Board Options Exchange and the Chicago Mercantile Exchange. He then spent many years as an independent trader of stocks, options, and futures. He then went on to MF Global and went into the futures brokerage business and joined R.J. O'Brien. In 2014, he joined the Options Industry Council, or OIC, where he is today. He's currently the Director of Business Development at OIC, where he oversees retail education programs. He also has a lead position in the production of options curriculum for the OIC. So without further ado, thank you again for attending our webinar today, and I'll turn it over to Ed. Thanks, Ed.
Thank you very much for that introduction, Gina, and welcome to our audience. I hope everyone is staying safe and in good spirits and is managing their health and their finances as best they can. I'm happy to be here. As Gina said, I've been in the business for about 23 years, all of it centered around the options product, but also with experience trading stocks and futures. But in my most recent role here with the Options Industry Council, I've been educating the public on the prudent and responsible use of the options product. Been giving these presentations online and in person for over 5 years now, teaching options. Today's topic is going to be hedging strategies, and I'll get to the outline in just a second. First, our disclaimer: options are not suitable for everyone. They are a complex tool that should be well understood before using them in a live account. I will have examples and profit and loss graphs up here today. Those will not include important costs such as commissions, transaction fees, margins, or taxes. Those are important costs in a live account, but we'll keep things a little bit simple today. And of course, any strategy discussed is not a recommendation to use that strategy. These are for educational and illustrative purposes only. A little bit more about OIC. We were founded in 1992 as an industry cooperative along with the options exchanges. Prior to that date, there was a lot of option myths that existed. I might address one or two of those throughout today's presentation. The exchanges and the brokerage firms all wanted an entity that did not sell anything, did not have any clients or manage any money, but strictly existed to provide free, unbiased education about both the benefits and the risks. You can't teach one without the other. And so that's what OIC is all about. We are found at optionseducation.org, and we have an investor services team that I would encourage you to reach out to if you have questions. It's a free service. You can reach them by email. The email address is there, options@theocc.com. I'll put that back up at the end. We're not advisors here. We don't offer guidance, but we can answer questions about the product and let you know what we have. We also do our own webinars every month, which you can find a list of on our website. I did want to start today with a look at options volume through the years and how much cleared volume there was. This is the number of billions of contracts per year. And you can see at the turn of the century, quite a sharp increase. Certainly electronic trading, the speed and access to which investors had to these markets increased. Also do-it-yourself investing and the knowledge and awareness of the options product all happened around this same time. And you saw this explosion of growth. 2011 was a year of heightened volatility. For those of you that go back, what's that, 9 years now to that trading year, you might remember the European sovereign debt crisis that kept levels of volatility elevated throughout that year. We had a spike in volume, and then really an encouraging sign where all of these years of very mild, low volatility, but still 4 billion contracts a year. I think it was 2017, I believe, when the VIX index never closed at its long-term average. It was below its long-term average for the entire year. Yet the options volume still remains strong. Now, here's what I want to focus on just very quickly to give you a snapshot of where we're at today. These record-setting volume numbers in 18 and 19. 5 billion is about 19.8 million contracts per day. That is this record-setting level. Now, here we are in 2020. We've had an incredible amount of volatility. So far, year to date, the industry is averaging 27.5 million contracts traded, almost 50% more than the average daily volume of these record-setting years. In March alone, there were 670 million contracts traded in just that 1 month, which set a record. That puts the industry on pace to go up to about 7 billion this year. It would be not expected that this pace continues, but it could. And that's the pace we're on here, about 4 months into the year to go at 7 billion contracts. Now, we know why this is happening. The markets are volatile. These are stressful times in more ways than one. So nobody's celebrating this. We know why it's happening, and it's because of serious circumstances. So instead of celebrating, it's more reflecting on the fact that options are being used more and more as investors are trying to navigate their ways through the most stressful market conditions. And that speaks to the value of the options product. The strategies I'm going to walk through today are outlined here. Hedging strategies, well, covered calls somewhat to a muted extent, so I'll spend a little bit of time there. It's a popular strategy, and I'll offer some commentary there. Then these final three will really be the focus of the hedging idea: protective puts, variations of the collars, ratio spreads. I'll explain what that's all about. Then a common theme, especially across these three, will be injecting volatility and definitions, commentary, and analysis of implied volatility levels. What are they, and what does it mean to have higher or lower volatility levels? How do those conditions affect these strategies? And I will certainly be walking through that concept throughout. Now, some of that discussion might get a little advanced if you don't absorb it entirely. If you're new to options and you don't quite follow that, that's okay. One thing I always say is there's nothing wrong when you're learning options to hear things that you don't quite understand. If it sounds logical, that's about enough. If you can't repeat it, that's okay. But hearing things over and over again, getting that repetition, is what learning is all about. So let's get started walking through the first strategy, and I'll explain how this is at least somewhat a protective strategy and a hedging strategy. And then, of course, the covered call is going to come into play a bit later when I get into collars. By definition, looking at options 101, the covered call has two pieces, one of which is long shares of stock, and the other is short a call contract. The investor sells or writes, those are synonymous terms, one contract for each 100 shares owned. Every options contract is written on 100 shares. If you own 500 shares, you could sell 5 calls. If you own 1,000 shares, you could sell 10. So for each 100 shares, you could sell one call option against that. And when you sell an option, you have obligations, which I'm going to outline in just a minute. The reason why you do this trade, the reason why you're selling call options, is simply to get the call premium, to receive option premium that could increase your returns, generate additional income. It also lowers your break-even point and increases the likelihood of success on the trade, gives you a little bit of a buffer to the downside. That's where the hedging idea comes in to a very muted extent, but gives you a little bit of a hedge. It's important to note that this strategy, just like the others I'm going to walk through today, are not bearish They are bullish strategies, but they offer some level of protection to the downside, some more than others. But bullish strategies, expecting the stock to move higher, but then using the options product, whether it's buying or selling or both, to protect some of that downside. In this case, owning shares and selling a call option. Let's break apart just the selling, the short call position and what that means. If you sell an option, you're under the obligation to sell or deliver shares at the strike price. You are paid premium in order to accept those obligations. Now, for equity and ETF options, assignment can occur on any day up to and including expiration day. Now, that means you could be assigned prior to expiration. It is possible. And that's what the term American style means, as opposed to European style. It has nothing to do with geography. American style options can be exercised on any trading day, including their expiration day. European style can only be exercised on their expiration day. Equity and ETF options are American style. So a little bit about when this might happen. In the case of call options, you will rarely see early exercise in call options in the absence of a dividend payment. Think about this from the option holder's perspective. If someone owns a call option, they have paid for that, and they own the right to buy shares of stock. If they are bullish and they expect the stock to continue to rally, there's no incentive in the absence of dividends. There's no incentive for the call holder to exercise early and purchase shares of stock. Remember, they have to pay for shares. There's no reason to do that before they have to. Before expiration, they could simply hold on to the call option and still enjoy the benefits of the stock rallying without having to pay for shares before expiration date. Now, dividends might change that. A call option holder is not eligible to receive a dividend payment, but shareholders are eligible to receive that payment. So if the option is in the money meaning that the strike price is below the open market value of the stock, the owner of the option can purchase shares at a better price than the open market value. If the option is in the money and an upcoming dividend is approaching its ex-dividend date, then you might see early exercise in that circumstance. To state it a little more deeply, the option holder, if they exercise, can still capture the intrinsic value, but they give up the time value. If the time value is less than the dividend they receive on the other side, they might exercise early. They also might just close the option and sell it and purchase shares to capture both the time value and the dividend payment. And with respect to closing early, here's where I'll address a myth that exists. I've heard many investors say to me that they've heard that many options expire worthless, that the majority of options that are traded expire worthless. I've heard all sorts of numbers, 80%, 85%. And it's simply not true. It is a myth. Data from the Options Clearing Corporation year after year consistently shows that out of all options contracts that are opened, about 70% of them are closed before ever reaching expiration. The owner of the option has sold it for something before ever reaching expiration. The profitability of those you really can't determine because you'd have to know execution prices, but they're closed. That's the point. Of those remaining, the vast majority expire worthless because the owners can't sell them for any value. They're worth nothing. So that's where the myth comes from, ignoring all of those closing sales and only focusing on that much smaller group of options that are held through expiration and expire worthless. So it's a myth. You shouldn't consider that a fact when you hear it and let that influence your approach to trading options. As investors say, well, if 80% are expiring worthless, I should just sell options all the time. And it's really not true. That is a myth. I want to walk through the P&L graph with a few comments here. This is always useful. I'll have graphs on all of our strategies here today. The stock is trading at in this case 52, and we sell the 55 strike call option for $1.75. So what does this look like? Well, if we bought shares at 52, you'd have this green dashed line, a profit and loss, very clean off of 52. You make money here, you lose money here. But by adding the options piece, we now receive $1.75. So at 52, we actually have a profit of $1.75. If the stock does nothing and goes nowhere, we make $1.75. If the stock rallies, we're obligated to sell shares at 55. We have elevated profits up until you reach this is 56.75 is where this intersection is. Once you go above that level, you can't make any more money, whereas if you own stock, you could. You give up all of that upside. Now, with respect to managing this position, one thing I could mention is you could stagger this strike, and we'll get to this also later in the presentation, but you can stagger the 55 strike, and if you have 1,000 shares instead of 100, maybe sell some options here at 55 and sell a few more at 57 and sell a few more at 60 and see if you can scale out to the upside and receive not as much premium as if you sold them all at 55, but varying levels and maybe give yourself some upside potential. But one other thing I want to talk about, if the stock goes extremely high, let's say it goes into the 60s, high 60s, at some point you have nothing left to gain on this position. The only thing you would have is risk. So all risk and no reward. The question is when. When does that happen? It's very important to be able to do this analysis. Once the time value of the option goes to 0, you cannot make any more money on this strategy. You can quickly calculate that. If the stock goes up to, say, $62, okay, it goes up to 62, and we sold the 55 call. The stock's trading at 62, and the 55 call option is now trading for $7. That's the intrinsic value. 55 to 62 is 7. If the option's trading for $7, then the time value is completely gone. And there's nothing left that you can make on this trade. If there's a week left or 10 days left till expiration or even a few days left till expiration and you've reached that condition, then you have all risk and no reward. And that's the type of circumstance when you might decide to just proactively unwind the position instead of just letting it go through assignment and having the shares called away. Maybe taking those few days of risk isn't worth it when you have nothing left to gain, and if the market crashes, you have everything to lose. So that's my comment on the upside. Now, what about the downside? Well, this is where your risk is. And the hedging aspect of the covered call is this buffer that you get, this $1.75. Now, in some market conditions, like we've seen recently, that doesn't seem like a whole lot, but $1.75 off of a $52 stock, and it's about a 3.5, a little less than 3.5% move down that you can suffer before reaching a break-even point, and that's a nice buffer to the downside. In fact, all the way down, the covered call outperforms long stock because you got this option premium. Now, if you do suffer longer, bigger losses, some of you may have had a covered call and really saw the stock get hammered. Well, there's not a whole lot you can do, but you can implement ratio spreads to try to recover that. And that's just forecasting what I'm going to get to a little bit later when we get to the ratio spread strategy, which is something you can think about doing with a stock position that is underwater. And there's the covered call. Now let's look at protective puts, and we'll outline what this strategy is about from a few different perspectives. It's a simple strategy, but we'll look at it from a few different angles to make it a little more interesting. This is the classic form of buying insurance on your portfolio. That's what this is. Investors or individuals are buying insurance on their health and their car and their home, but sometimes are not buying insurance on their portfolio. Now, insurance can be expensive. In fact, you would expect it to be expensive, and you hope to never use it. But if you do have it, and the circumstances dictate, it might be something that you value very much. Now, there's some common terminology that you can relate between insurance policies and the protective put position. First of all, the deductible. When you're in your classic insurance policy, the deductible is how much money out of pocket do you have to spend before the insurance will kick in and provide you with coverage. In the case of the protective put strategy, that amount is the difference between the current stock price and the strike price of the option. When you buy a put option, you pay for it, premium is paid up front, and you own the right to sell shares at the strike price. That is your guaranteed exit point of the stock position. The difference between today's stock level all the way down to that strike price is the amount you're willing to lose or give back before the coverage kicks in. Of course, the lower strike price you choose, the higher your deductible is, and the less the insurance policy is going to cost. The higher strikes will cost more and get you out of the trade earlier. Then one flexible portion to mention is you can determine how much of the position you want to cover. Do you want to spend a lot of money for quick coverage and have a low deductible? Do you want to go further out and just protect against tail risk and spend a little bit on your insurance? Do you want to protect the entire position or part of it? You have all those choices when you select or construct the position. And here's what the protective put looks like on a graph. Our example stock's at 60. And we're just going to go ahead and buy the 60 strike put for $1. So what happens is the dashed line is buying stock at 60, and the clean profit and loss with significant potential downside risk. Now, if we also buy the put option, we pay $1, so our cost is not 60, it's 61. $61 is your cost basis. We have to make that back in order to break even, and then we can experience profits, and we have now maximized our potential loss here. Now, some people may think that this is a substitute for a few other things you can do to protect the portfolio, one of which might be fluctuating your cash position. When you're concerned about a market moving lower, you might think, well, I'm going to reduce my market exposure, sell off some of my positions, and increase my cash position. And that's certainly a viable, reasonable approach. You can protect downside losses with a smaller position that is exposed to the market. However, if stocks go higher and they do rip to the upside, you don't have as much of a portfolio to capitalize on that. And that's what you give back with the cash position toggling approach. You can also think of this maybe as an alternative to using a stop loss order. If this stock here were to rally up to, say 65, 66, and you've got this put option, well, an alternative would be just to put in a stop loss at the strike at the price of $60. And you certainly could do that. The big advantage with using a stop loss is that it doesn't cost anything. Buying the put is going to cost something, and it's not going to be cheap. A stop loss isn't going to cost you anything. Also, the put expires at some point. It has an expiration date. If you didn't need the insurance and you've reached expiration date and you still want the stock, you'll have to buy another insurance policy with a stop loss. You don't have to do that. So those are two huge advantages to using the stop loss order as opposed to puts. However, the put option provides 24/7 around-the-clock protection, and it doesn't get you out of the position as soon as the stock trades down there to 60. And that's a benefit. If there's a flash crash from 65 down to 55, and then the stock rips back higher to 65, a stop loss will have gotten you out of that position at 60. The put option is there through expiration. The stock can drop, then come back, and you don't necessarily have to get out of your position. You can just hold it and then see where the stock moves from there. So there's different ways to do that. As far as quantity here, similar to the covered call, each option is written on 100 shares. It's very simple. If you have 500 shares of stock, you could purchase 5 put options. You could purchase 3. You can purchase 1, or you can overhedge. If you really want to be protective, you can buy 6 or 7 puts and spend an awful lot of money on that downside. But now, if something awful happens, you're not just protected, you've got a few extra puts to the downside that you can use to maybe experience some profits off of. There's different ways that you can manage that, and that's all with respect to equity and ETF positions if you wanted to hedge those directly. Let's look at it a little bit different way. What about an entire portfolio that you want to protect? And this is going to be maybe not necessarily an intuitive calculation. You've got a portfolio value of $100,000 and you want to protect against greater than a 10% downside move. So you're willing to give up the first $10,000 and you want to protect the remaining $90,000. So how do you do that? First of all, you have to find an index or an ETF that you believe is going to closely resemble the performance of your portfolio. We're not going to specifically identify that ETF or index here today, but let's just say, for example, that you're using SPY, because I'm going to use that symbol a few times as an example. So you're using SPY. Let's say at that time it's trading for 250. Well, if you're willing to give up the first 10%, then that means after that 10% move is experienced, the SPY is going to be at 225. So you want to buy the 10% out of the money put from 250 down to 225. Now you've selected your strike price. Expiration date is totally up to you. How much protection are you willing to pay for? How long do you want it? That is going to be a decision you make depending on maybe some market analytics. When do you think a correction might occur? Are there any events on the calendar that you think you want to cover until you think they will no longer be a concern? You pick your own time frame here, 90 days going out, 10% out of the money, 90 days, paying $3. Now here's where I'm going to start to talk about volatility. First, with definitions, for those of you new to the concept, one of the most important inputs to the price of an options contract is the implied volatility level of the option. There's two types of volatility. First of all, historical volatility. This references stock movements that you've already witnessed. What is the historic volatility of past stock price movements? You can look at it in different intervals, maybe a 10-day or a 30-day or a 200-day. Looking back, what has the stock done in the past? That's useful information. But of course, the options market is not going to price options contracts based on what's happened. The options market is looking forward between today and expiration date. So the volatility level used to price an options contract is not historical, it's implied, and it's forward-looking. The historical measure can help determine what a reasonable level for implied volatility levels should be, but of course, current circumstances will change that. And the implied level between today and expiration date is what's used to price an options contract. By definition, implied volatility is the volatility level that justifies an options price. Now, looking at our example here, and our examples come from using the options calculator. You can find them from various resources. Using an options calculator at maybe, let's say, a normal or a calmer implied volatility level. And I'm just going to use 24% implied volatility because that will get you about these numbers, 10% out of the money and $3 for a 90-day put option. 24% implied vol at this level. Now, that would be in normal circumstances. Today, looking at maybe today's environment here in late April, maybe this 10% out of the money put is trading for 37 or 38% implied volatility. That's more of a realistic look at today's environment. And if that's the case, you can put that into a calculator and see what might the option be worth. Well, instead of $3, it's going to be worth about $8. That's how much of an effect implied volatility movements could have on the price of an option. Today's SPY, 10% out of the money put going out about 90 days or so would be maybe $8, $7 or $8, depending on where implied vol levels are as you're looking at them today. So certainly this price is going to fluctuate. Back to our example. What we're trying to do is figure out how many of these puts to buy. We want to protect $90,000. We've determined 10% is the move we're willing to give up. There's our strike price. We're fine with 90 days. So we've identified the put option along with its premium. Now, how many do we need to buy? This is the calculation we're trying to figure out, and it's very simple arithmetic. You take the total amount of the portfolio that you want to hedge and divide that by the notional value, or you might have heard this as the aggregate value of the strike price. $90,000 divided by this term is 22,500. Now, where does this come from? Another way to describe this is if everything goes to zero, if all stocks, all indices, all go to zero, you need your options to pay you back $90,000. If you exercise this put, you know that you'll receive the strike price times 100. And if everything's at zero, you're delivering worthless shares. So each option is going to pay you 225 times 100 or $22,500. You need 90,000. So there's your equation, and there is the calculation to 4 put options. And you can now decide how much do you want to spend. Buying 4 put options is going to cost $1,200. That's your cost to buy all of the insurance you need on the portfolio, given the parameters that we outlined. You can buy less than that, protect half your portfolio, and buy 2 puts if you think that's too expensive. Or maybe buy a few puts at 225 and then reach down lower and pay for cheaper insurance at a lower strike. Or if this is very comfortable and you thought, maybe I'm more concerned about a market move, insurance is extremely valuable to me right now, I'm willing to spend a little more than this. You could buy 5. That gives you one option. You can maybe sell for profit and still protect your portfolio at some point, or you can move your strike price up and look at the 230 strike and see where that is. All sorts of different things that you can do to toggle how you construct this position, but I have to just repeat, this assumes a one-to-one correlation between your portfolio and the product that you're using as a hedge. Undoubtedly, there will not be a precise one-to-one correlation. There will be some variance between the performance of your portfolio and your hedge, and you have to keep that in mind. I often get asked the question, how do you determine which ETF or index to use? And that's going to be a question everyone will have to answer for themselves, working maybe with your firm, or just looking at your portfolio and saying, what industries do you have covered? Is it extremely diversified? Are you exposed to a particular stock or industry more so than others? You might choose then a couple of different ETFs, doing the same type of analysis on how to calculate how many to buy. And so that's covered calls and protective puts. Now let's get a little bit more complex and add another piece. I'm going to talk about the collar position from a few different angles and walk through variations of the collar. Now this is a couple strategies in one. I'll get to that in a second, but largely or frequently the collar is used to start to unwind a position. This might be a consolidated position that has increased or built up over time, or maybe it's just a position that you've made money on, the stock's moved higher, and now you're almost ready to start getting out. Maybe you're looking for another 3%, 5% to the upside before you start to sell your shares, but you don't want to give up all of the downside, and that's really where the options collar comes in. There was a very good reason why I walked through those previous 2 strategies. Not only do they have different levels of protection and can be considered a hedge, but the collar consists of a merging of those 2. On the downside, a protective put, that's long shares, and long put, protecting the downside from a significant move lower. And on the upside, it's a covered call, long shares and short a call option. Now the shares, the quantity of shares is not double. This would be at its lowest level 100 shares, long 1 put and short 1 call option. The driving force behind this trade, the motivation is buying protection and not giving back the gains that you've experienced, while on the upside, being ready to sell shares of stock instead of paying for the insurance entirely. The sale of the covered call brings back some premium and offsets a large portion, if not all, of the cost of the put option. On a profit and loss graph, here's how it looks. The dashed line again is buying shares and just holding them, where you have the options collar imposed here on top of that. Long shares at 75, and now you have the options pieces that make the collar. Buy shares at 67.5 strike price and sell at 82.5 strike price. Net debit in this example is 40 cents. You'd have to make back that 40 cents at expiration to break even, 75.40. Your long shares will continue to gain, and you start to get out of this position at 82.5. And well, in this case, you exit the entire position because we're just doing 100 shares. But if you had 1,000 shares and you were selling, 5 call options and buying 5 puts or something like this, you could start to unwind your shares up at 82.5 and cap your upside on those shares. Now, if the stock drops, instead of experiencing potentially all of these losses on a significant downside move, you're protected at 67.5. And that is where the downside and the risk management comes into play with this strategy. If the stock consolidates, you have a decision to make. Do you want to just do this strategy again or implement something else? And of course, if you have the upside or downside move, your options may dictate what the position looks like after that. One thing to note, you may have noticed this, the stock price here is at 75, and the strike prices chosen are $7.50 away from that. We went $7.50 down and 7.5 up, and the premium of the put is greater than the premium of the call. And this is the opportunity to talk about volatility skew and what that means. Every single strike price here has its own implied volatility level. The lower strike prices in these put options down here tend to have more demand. The higher demand, the higher the price of the option. And remember what I said before, implied volatility is the level of volatility that justifies a particular option's price. There's more demand and the price of the option is going higher, then the implied volatility level is higher. And because investors and money managers are more often buying put options to protect downside moves rather than buying call options to speculate, you tend to have higher demand, higher bids, and higher implied volatility levels here on the downside. Now, what you can do if you analyzed the implied volatility level at each strike price and you plotted it, you could draw a volatility skew. That's what volatility skew would be, or a volatility curve, by connecting the dots. And what you'd see at these low levels is you'd have very high levels of implied vol, and that level would come down. When you get to the stock price, it would level off and bottom out here just above where the stock is. That's considered your most calm environment when the stock is just gradually and slowly moving higher. So bottom out here and then drift up and tail off a bit. And that would be your classic looking implied volatility skew. Now, it doesn't necessarily have to be that way. There could be a flat skew across. There could be an inverted skew. Every product is going to be a little bit unique. But those inverted skews, you might notice that in products like commodities, where you may have a strong moves to the upside, or maybe flat curves in products that can move in either direction with an equal amount of velocity. But the normal traditional curve is as the way I've defined it. So because implied volatility levels and demand are higher over here than they are over here, the 67.5 put is going to cost more than you can receive from the 82.5 call. There's something known as the zero cost collar. If you wanted to execute this at even money instead of paying something for it, then you would have to change how wide you go on this spread. Maybe use a lower strike put to lower that cost, or a lower strike call to increase the credit. Either way, you're toggling this against you. If you lower the put, you're taking on a greater deductible. If you lower the call strike, then you are exiting the trade earlier, and that is what you would likely have to do to get this trade at even money. Now let's look at a few variations of the collar. I will often get asked, what if I staggered expirations and I bought a long-term put option to protect this position, for an entire year, a put option that expires a year from now, and I sold calls maybe every week or every 2 weeks or every month. And the reason why you would do that is the time decay is much faster for shorter dated options. Now, options do not decay in a linear fashion. The at the money options or the near at the money options decay at different rates depending on days to expiration. It's generally considered that 30 days out, you'll hear different numbers here, maybe 35, 40 days, somewhere in that area, time decay begins to accelerate. So if you bought a put option that expires in a year, it's going to decay very slowly. And if you were selling options that were much closer to expiration, then your decay is much quicker. And if you could continue to sell call options every couple of weeks or every month, then you would take great advantage of this time decay dynamic. And that is true if the stock were to consolidate or move slightly higher, and you had the opportunity to witness your call options expire and then continue selling calls. That would be true. However, you have to be very concerned. Of course, less time means less premium if you're selling shorter calls, and there is a huge move in either direction, then you would perform worse than the traditional collar. Think about that. If the stock went all the way down to zero, your put provided you protection, your call went to zero, it's worth nothing, and you're out of the position. You have nothing left. You paid an awful lot for a long-term put. You got almost nothing for the short-term call. The traditional collar would have performed better. Same thing on the upside. If there's a huge move to the upside and you have this staggered collar on, the put option you bought goes to zero very quickly. The call option is subject to assignment, takes you out of your position. And again, you paid a lot for your initial construction of the options pieces, and it would not perform as well. Certainly, staggered collar is a possibility, but keep in mind those dynamics and make sure you're using them appropriately and you understand the risks and what can go wrong. Another variation of the collar is to implement the put spread collar. This is rather simple. You have your traditional collar, stocks, you have 100 shares starting from 105, stock rallies up to 120. And the traditional collar would say, all right, let's buy the protection at 115. We don't want to give back all these gains. And we're going to sell this call option, try and get another, 5%, 4.5% or so to the upside, and then start to get rid of the shares we own. And there's your traditional collar. But remember, this position protects the stock all the way down to zero. You might think to yourself, well, I don't need all of that protection. I'm paying $360 for a lot more insurance than I actually need. Maybe you can drop down to a lower strike and sell a put option, which receives premium and eliminates the insurance or the protection underneath this level. You bought to protect at 115. Now you're going to sell or give back that insurance if the stock drops under 105. That's because you're not concerned about a move that large. In exchange for that, you're paid $1.60, and now you have a different cost structure. I'm not going to walk through all the numbers here, but a different cost structure having the put spread versus just the traditional collar to the upside. You're still maximizing your potential gain, but you do have a much greater downside buffer because you have a better cost structure initially. All of these numbers, they really look a lot easier on the graph, so I'll just go right to it. Remember, the stock's up here at 120, and if the stock rallies, well, you're subject to assignment right here, and if the stock drops, then you are protected for this $10 range between 110 and 105. You've got protection, at which point below that you give the money back, and that's when the protection goes away. This put spread collar is a little bit more complex. It's got 4 pieces to it. And again, talking about volatility today, I will mention this could be a way for you to take advantage of high volatility levels by selling an extra option. And there's, as I said before, volatility skew. There's a volatility level for each strike price. Well, the steepness of that skew is going to be different for each stock. You may look at the 105 versus the 115 and notice there's a huge difference in volatility levels there. Maybe there's an 8–10% a difference in implied volatility levels between these two strikes. That may give you some more incentive to sell the 105 put option. If the skew was steeper than the example when I put this together, then the premium would look even better. And you would get more for your put option versus the put option that you paid for, improving the cost structure even further than that. And that's a lot. There's a lot there for the options collar because there's moving pieces, long stock, short a call, also long a put, and potentially short another put. Also, you can stagger that expiration and strike price to the upside. So lots of different things you can do with the options collar. And the last strategy to walk through today is stock repair. I foreshadowed this a bit earlier. If the stock position is far underwater and you're losing money or you've experienced a much bigger loss than you thought, this could be as a result of having a covered call position that's gone much worse than you thought it could, or a cash secured put. You sell puts and you're willing to take on the shares. If the stock gets crushed, now you're long shares from a far lower level than you ever expected to be. And selling calls, even at your cost basis, may not even be something that looks appetizing to you. So let's look at what this is. It's a ratio spread using calls only for the purpose of lowering the break-even point to get out of a losing stock position. Now, there's a lot of benefits here that I'll walk through. I'm just going to say right up front, what you're doing in exchange for all these benefits is you're going to give up any upside potential to profit. That's what you give up. But let's see what this looks like. The investor is long 100 shares from 65. The market declines. Shares are currently trading 57. Now, key, as all the strategies today, the investor is still bullish. If it's a hold and hope situation, maybe it's time to just exit. But if you're still bullish, and now you're just looking to get back your losses and get out for break even, well, one thing you can do is just stay the course, hope there's a rally, maybe get out at your break even at 65, maybe hold it, cross your fingers, or you can add more shares, double up the position, scale in further. That can lower your break even point. If you double up, lower your break-even point to 61, but you're paying for another 100 shares. That is going to be cost intensive and require additional funds. Or implement stock repair to accomplish a lower break-even point to require no additional funds, no additional downside risk at all, but giving away all of the upside potential. And here's what this will look like. Here's the graph, but let's outline it first. Long 100 shares from 65. Stock has cratered down to 57. The ratio spread would suggest buying one call option at the strike price equal to the current level of the stock, and then selling two call options at a strike price right in between these two levels of your entry point and the current level. Buy one option, a call option at 57, sell two call options at 61. You're doing this in our example at even money, more on that in a second. And now look what happens at 57. Below 57, the options expire worthless and you're left with long stock. The same risk you had before. No additional risk and no benefit, but no additional risk if the stock stays below 57. If the stock rallies, well, you're long 100 shares and you're also long the 57 calls. So you've effectively doubled up your position. You'll make your money back twice as fast until you reach the 61 level. Short 261 calls, or short two of the 61 calls. You're obligated to deliver 200 shares of stock. 100 of them you already own. The other one you can get here from the long call. So you're obligated to deliver everything you own, and that will take the position out at 61. Lowered the break-even point from 65 to 61, didn't pay anything extra, got out of the trade potentially much earlier, didn't take more downside risk. That is the benefit of stock repair. Now, volatility, again, discussing volatility. In higher volatility environments, you can expect to witness, possibly a change in the premium difference between these two call strike prices. As vol increases, especially significantly, the difference or the skew between the two strikes tends to be less significant. Now, the skew itself can change, but just volatility changing all by itself, volatility across the board moving higher, you would expect the difference between 57 and 61 to shrink just a little bit and maybe get a better premium amount for your ratio spread here, 1/2. That can leave you with a credit. Also, choosing your expiration date. The further out you go in expiration date, the greater likelihood that you can get this at even money or even a credit. The further out you go, the premiums fan out and they start to come together a little bit. You might get a credit here as well, choosing a long-term expiration. The downside to that is that possibly you're going to be stuck in the position for a greater period of time, and that may not be something that you want to deal with. But strike price selection is really clearly identified, the current level and then halfway in between, and then the dynamics of the market, current levels of implied vol and your choice of expiration date. That's going to determine whether or not you get this at even money or not. Last thing I'll say here to keep in mind, maybe some of you might say, well, the perfect situation here is to get this together. And if the stock sits here at 60 or 61 at expiration, now you're coming back. Maybe you thought this move down is over. There was a significant level of support here and it's bounced off and now it's going back to 65. You can sell your 57 calls. Let's say the stock's at 60 and you're at expiration. Well, the 61s are going nowhere. You can sell the 57 calls for $3, put your $3 in your pocket, maybe buy back these 61 calls for next to nothing, very, very little if you're doing this possibly on expiration day. So you pocket the $3, roughly $3 from the 57 calls. Now your cost basis is down to 62. And you can just continue to hold the shares and maybe see if they rally from there or change this into something else. Now, if you're back up at 60, cost base is 62, maybe you just buy a protective put, hold the stock, or sell a call, turn it into a covered call. Different things you can do depending on where the stock ends up at expiration. We'll walk through a lot of different strategies today. They have varying degrees of protection or hedging aspects, but all of them unique to themselves and offer an awful lot to think about. So I hope you got value from all of that. Again, our contact information, website, optioneducation.org, and you've got our investor services team there to answer your questions, which I'm going to do now. I'm going to take just a couple of questions in the few minutes we've got left. Looking at the board. One question is coming in about being a beginner to using options and how do you get started? What's the best way to get started? Well, this is a tough question. I get this one a lot. Certainly you have to have the education, so utilizing all educational resources you possibly can to make sure you understand rights and obligations and premium amounts and you know what volatility is. Now, a lot of investors aren't going to have an opinion when they look at an implied vol level. Is it high? Is it low? They're not going to know what that is, but knowing what those levels are, at least numerically, and understanding why is all important. But paper trading, when you feel like you've got that foundation of knowledge, you're ready to start implementing strategies, you've got some method, technical analysis, fundamental analysis, or maybe an advisory service that you're using to view the markets. Once you've got all of that down, paper trade some strategies and see how they change over time, understand why the changes in premium take place, and then start small. Once you've done your education, you've paper traded, you're comfortable, start small, put in some small trades, and try and avoid getting surprised before you do anything on a larger scale. And everyone's going to be a little different in how they approach getting started for beginners. I have a question popped in. How do you select the strike price for the ratio spread? Again, there is some methodology to that. If you're long stock at a particular level and you've suffered this huge loss, this is generally your first strike price. That 57 is going to be the long strike of your call, 57. And then in between, halfway, so this is an $8 drop, $4 is halfway in between, that would put you at 61. That is the level for your 61 strike call. Now, if the stock has dropped much more than this, let's say it went down to 50 or 45, and then you try to use this calculation that I just suggested, it's going to be hard. One of the limitations you might find here is when the stock has dropped so far. Let's say it goes even further. Let's say it goes all the way down to 35. You've dropped $30. Well, halfway in between that is going to be 50. So you would be buying the 35 call and selling 2 of the 50s. The 50s are so far out of the money at that level, there's just going to be no premium there. So you do have to look on a case-by-case basis and determine what that is. But the calculation is the current level for your long call and then halfway in between for your 2 short calls. Let's see what else we've got. Can you sell calls on a stock that you don't own? Well, this is quite a loaded question. Selling calls on a stock you don't own. When you sell a call option, you're under the obligation to deliver shares that you do not own. This has the same risk profile as being short stock. However, when you're short stock, you can make an awful lot of money if the shares decrease. If you've sold a call, the only thing you can make is the premium you received. The answer is, by definition, yes. It's called the naked call. You can sell calls on a stock that you don't own shares of, but it is the highest risk options trade that exists with usually not much benefit as far as premium. You can do it. It would likely take the highest level of options approval in your account. I would strongly recommend reaching out to your firm to discuss that. It is a strategy. I don't want to scare people away from it. Some people do use it. You can combine that with possibly a long call at a higher strike and turn it into a vertical spread to have that naked aspect removed. But yes, you can do it. It's very risky, and it would take likely the highest level of options approval in your account. Good questions, and thank you for sending them in. About to wrap up here in the final minutes, so hopefully everyone was able to enjoy the presentation here today. And Gina, I will turn it back to you for some final remarks to close things up.
Okay, great. Well, thank you, Ed. That was very informative, and we appreciate it. And also, thank you to everyone attending this call on behalf of eOption. Just to highlight a few points, Ed mentioned that paper trading is a great way to start with options. And if you go to eOption.com, you'll see a box, a big blue box says open a demo account. And that way you can open a free demo account to start paper trading if you'd like to give some of these option strategies you learned today a try with no risk. And also, some of you have asked about a recording. We will be making the recording available in the next week. If you go to the eOption.com website and go under the education tab, if you go under webinars and videos, you will see it posted there, as well as we have past webinars and videos. So if you'd like to learn on different topics, you'll find that as well. Our next webinar will be in approximately 2 weeks on May 13th on some more advanced hedging strategies, and we will be notifying you as well. And you can also find that under our webinar tab on our eOption.com website. And that'll be up tomorrow if you want to start signing up for that. And make sure to like us on Facebook, like eOption, and you'll also get advance notice of webinars and trading tips and investment advice as well. So thank you to everyone for attending on behalf of eOption. We greatly appreciate it. And everyone be safe and stay well. Thank you.